Hello. So today we're going to talk about the yield curve, which is a very important topic, a very important segment of the financial markets, but it isn't actually spoken of that much in banks outside of, say, the treasury function or the money markets. So the yield curve, what is the yield curve? Let's draw one now, shall we? So along the x-axis of this graph, I've got time to maturity, T for time. And along the y-axis, I've got percentage, meaning interest rates. And that's what a yield curve is. It's a plot of interest rates over time for the same sort of borrowing. So just imagine I'm the UK government and I want to borrow money. All governments, apart from one or two minor, very few exceptions, borrow money from the international capital markets to fund public expenditure. So if I'm the UK government and I want to borrow money, the rate that I pay on the money I borrow would be plotted on this graph. So the 1 year rate might be here, and the 2 year rate might be here, and the 3 year rate here, so on and so forth, until we get to whatever the longest maturity of borrowing I am undertaking. So if I borrow 5 year money, then the interest rate I pay for 5 years will be plotted, I'm in between here, aren't I? That's no good. Will be plotted about there. Okay, now a curve joins the dots, so to speak, and there's lots of textbooks of describing methods one would use to join the dots. Okay, so we've done that here very easily, just like that. Okay, and that is the yield curve. It shows you the relationship between the time value of money and the interest rate payable by someone who's borrowing for that period. So that is indeed the yield curve. Now, as I've drawn it here, we can see that the interest rate is higher the longer I want to borrow. And that is known as a positively sloping yield curve. Now that's conventional, that's orthodox. That's what one would expect to see under most financial market conditions, most economic conditions. Because if you think about it intuitively, if I want to borrow money for 5 years compared to borrowing money for a year, I would probably expect to have to pay a bit more because the person who is lending me that money will want a higher rate of return. Remember, we have to pay the rate that our lenders, our creditors, charge when they lend us money. So that's why we have a positively sloping yield curve under most stable economic conditions, because we expect to pay more, a higher interest rate, the longer we borrow for. Now, an ability to borrow money is not universal. Just like an individual's credit score or credit rating, the higher the credit rating of the borrower, the lower interest rate it pays on its borrowing, but also the greater its ability, the borrower's ability to borrow money from a wider range of lenders, and also over a longer term. You might have a credit rating a company might have a credit rating that enables it to borrow for up to 1 year, but not have a rating to borrow for 5, 6 years or longer. So think of the longest dated borrowing that any particular borrower might have, and the higher their credit rating, they'll be able to borrow over a longer term. Okay, so that is our yield curve, and it's positively sloping. Now, under certain economic conditions, the curve doesn't look like that. It actually inverts. In other words, the interest rate for longer dated borrowing is lower than the interest rate for shorter dated borrowing. Now, why does that happen? There's a number of reasons, but mainly it's to do with an expectation by the market, by lenders, of where they think rates are going to go. Remember, the central bank in every country sets the short term, the overnight interest rate, let's call it the base interest rate. They set that rate, and that's the rate that they lend money to other banks. So the central bank manages monetary policy by setting the overnight interest rate. And that, there's an expectation of where that's going to go. Investors, people who lend money, and indeed people who borrow money, will have an expectation of where they think the overnight rate, the central bank base rate, think of the federal funds rate, or the UK Bank of England's base rate, or the European Central Bank's base rate, monetary policy rate, or any central bank's base rate. There's an expectation of where it's going to go. And if we think that rate is going to be falling in the future, then the curve might start to invert, because but when the market clears, the rate at which lenders will lend and the rate at which borrowers will borrow at, there's obviously got to be an agreement there, otherwise the transaction doesn't take place. If there's an expectation that rates are going to be falling, the central bank base rate is going to be falling over the next 6 to 12 months, then longer dated rates will fall. So we'll end up with a inverted yield curve. And that's usually a sign of an impending economic recession, because central banks, I'm speaking generally here, a generalization, they drop rates when there's a recession expected, or when if the economy is in a recession, and they raise rates when they think the economy is growing. Now that's traditionally always been the case. It's not always the reason for it, but it's the main reason one would have an inverted curve. Okay, so there we go. There's the yield curve for you. Hope that's been interesting. Thank you. Bye-bye.